Rowe Price stock, ticker symbol TROW. Is this the best dividend growth stock to buy right now? This stock is up 11% year to date, which is a small difference with the overall market. The S&P 500 is up 7.8% year to date. On the 26th of January, TROW presented quarter results where they beat on EPS but missed on revenue by a small margin. The reason why people love TROW is because of the dividends, of course. Dividend yields of 4% and they have grown the dividends for more than 36 years in a row. But does this also mean that TROW stock is a buy? Well, in this video I'm going to show you real quickly what Rowe Price does. The most recent earnings report, the fundamental analysis, dividends, returns versus the S&P 500, and in the last part I'm giving you my price target to see if they are a buy or not. And I think you definitely want to see that part, so make sure to watch until the end. And I'm also very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does TROW do? Rowe Price is an investment management firm focused on helping clients meeting their objectives and achieve their long-term financial goals. The company earns a percentage fee based on the amount of assets under management in any given mutual fund. When we dive in the earnings, we see that they reported 1.5 billion in revenue versus 1.9 billion prior year. So there's a decrease that worries me a bit. The biggest decrease is within the investment advisory fees. When we zoom in on this segment, we see that equity is by far the biggest sub-segment and it's down most year over year. And that's also reflected in the assets under management, of course. Equity is down the most, so this is definitely something to keep your eye on. The management stated that to address this decline and protect the capacity, they focus on controlling expenses by cutting third-party spend, slowing the pace of hiring and reducing headcount by 2%. So it's expected that by doing this, margins will be okay, which is something that I really like, of course. A good thing to see is that TROW reported month-end assets under management of 1.35 trillion as of January the 31, up almost 6% year over year. So assets under management is increasing again, which is of course something that comforts me a lot. And now that we know more about this company, it's time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. TROW is a 27 billion market cap company with a PE ratio of 13, which could indicate that they are undervalued. Later in this video I will show you my 3 price targets for Rowe Price, so make sure to watch until the end. Because PE ratio is only telling a small part of the full story here. Revenue is at 6.93 billion and in this graph we see that revenue went up in the long run. However, most recently revenue started to decrease a bit, which concerns me a bit as well. So this is definitely something to keep your eye on. This also has to do with the overall market conditions, of course. It's the same story with the margins. Over a longer period of time, margins are going up quite nice and steady. However, most recently we see a decrease in margin. Again, this is also related to the market conditions right now, which is also reflected in the EPS. We see a steady increase over the past couple of years, but again, most recently things don't look that great. Price to sales ratio is at 4.2 right now. It's pretty high right now, but keep in mind that companies like TROW have a higher price to sales ratio in general. And it's the same story with the price to book ratio. This number is a little bit too high right now, but it's also looking better than the price to sales ratio. Price to free cash flow is around 10, which is all fine by me. It's looking quite good in my opinion. Analysis expect EPS to increase in mid-single to high single digits in the coming years, which is of course very nice. Revenue is expected to decrease quite a bit, which is very interesting. I think in the short term we might see some difficulties with the revenue, but in the long run they will be fine in my opinion. Return on assets is sitting at 16%, which is really nice. Return on equity is also looking good, and the most important number, return on invested capital, is sitting at 16.5%, which is very nice. But the thing that I don't like here is the fact that it's lower than the 5-year average, so that's something to keep your eye on. Nevertheless, 16.5 is still a really good number. Current ratio is at 2.77, which is above my maximum of 1.5, so this is something that I don't like. For me, it's very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And in this graph we see that free cash flow is going up kinda steady, so this is something that I like. Shares outstanding is going down in the long term, which I really like of course. To me it's very important that shares outstanding are decreasing, since it increases your ownership in the company, increases the EPS, lowers the PE ratio and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyway, dividend yield is sitting at 4%, which is a really high number and loved by many investors. Annual payout is at $4.88 and payout ratio is at roughly 60%. I prefer 50% or lower, so right now they have 40% left in cash to buy back shares, do acquisitions, pay down debt and do all other things. The 5-year growth rate is at 16%, which is really good. And they grew the dividends for 36 years in a row, very impressive. Overall, a great looking dividend scorecard, but how about the historical returns? I decided to compare TROW stock with the overall market, in this case the S&P 500. Next to that I added Charles Schwab and BlackRock. We're looking at returns including dividends. On the 5-year chart we see that the S&P 500 had beaten all the stocks in this list, so that's quite interesting. TROW had the lowest return with 31%. On the 1-year chart we see that TROW again had the lowest return with minus 12%. Only BlackRock had beaten the S&P 500. On the 6-month chart we see that TROW stock was the only one beaten by the S&P 500. Both Charles Schwab and BlackRock had beaten the S&P 500. On the 1-month chart we see that the S&P 500 again had beaten all the stocks in this list. But it has to be said that TROW had the highest return after the S&P 500. So bottom line, TROW was beaten by the S&P 500 in the long run, and also by the other companies in this list. Does that mean that TROW is an interesting buy right now after underperforming for the past 5 years? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 0, 3 and 6%, since I think they will increase the revenue at the same level as they did historically, and also based on the analysis, expectations and earnings report. Profit margin I'm filling in 27, 29 and 31%. For the free cash flow margin I'm filling in 30, 33 and 36%. For the PE ratio and the price to free cash flow I'm filling in 12, 13 and 14, because I don't want to overpay for the growth. My desired annual return is 12.5%, since I can get an easy 10% average annual return with owning an ETF. Right now TROW is at $121. I hit analyze and we see some green numbers. We have a low price target of $76 to $84, which is quite a big drop. We have a mid-price target of roughly $105 to $118 and we have a high price target of $142 to $165. To me, the mid to high price target is the most justified here. So that means 105 on the low side all the way up to 165 on the high side. So this could mean that TROW is undervalued right now based on these assumptions. And if I have to choose, I'm leaning a bit more to the high price target for now. My final conclusion is that I really like the business. They have a proven business track record, but most recently and in the coming periods, things don't look that great. Revenue is decreasing and so are some other important fundamentals. Of course this worries me a bit in the short term, however I feel very comfortable about the long term, and with dividends sitting at 4% dividend yield I'm all good for now. They increased the dividends for 36 years in a row, so they know how to keep the dividends growing. For now I'm slowly increasing my position in TROW since it's already a big position in my portfolio. I started buying TROW stock at $100 and I'm planning to buy some more very soon. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.